This is Scott Becker with the Becker Private Equity and Business Podcast. We're thrilled today to be joined by Matt Wolf. Matt's a brilliant leader and analyst and thinker at RSM. He talks to us regularly about the trends he's watching both in healthcare and in private equity. Matt, why don't I let you take it away? What are you watching currently? What's going on in the healthcare investment area, in the private equity world? What are you seeing currently?
Yeah, thanks for having me on, Scott. So, we keep focusing a lot on the interest rate environment, right? We've had some very positive inflation data come out over the past week or so, both alternative data and official data. I think the market is sort of settling into this expectation that we'll get one more raise in May, and then hopefully, or perhaps a long pause. Certainly there are still some optimists out there that think we won't get another hike. We might even get cut. That's not our position. We're here for the raise in May and then the long pause. But I think more importantly, we're seeing sponsors and investors really settle into this environment and change their deal strategy and how they go to market. Still not seeing as many platform acquisitions or kind of larger scale acquisitions, fewer highly levered LBOs. They're just, the economics of that is it's just different than they were back when money was free. I'm still seeing a lot of tuck-in acquisitions or smaller add-on type deals. But what's interesting too is even on those deals, we're seeing a lot less leverage. I've worked with a few sponsors who are actually just funding all of their add-ons with 100% equity.
Talk about that for a second, because I see, like we just talked to somebody the other day, they've raised like a $6 billion fund. They have to put that money to work. They're certainly not going to leverage it like they used to, but there is money out there that people very much want to put to work. It was sort of a fascinating call to see, there's still so much desire to find deals to put money to work on, but albeit, as you said, with probably a little bit less leverage, but there is money again chasing deals, isn't there?
Oh, absolutely. Yeah. So we're seeing less leverage on these deals. We're still seeing the deals happening. And we're also seeing a really interesting trend where some of these private equity funds are buying those term loans or revolving loans from their banks, right? They're buying them at 60, 70 cents on the dollar. These banks want to get out of this change in interest rate environment. They're trying to change their credit risk exposure. So some of these funds are buying their portfolio company's own debt from the lenders at a discount as another way to put that money to work. It's fascinating.
I mean, right. It really is. And you also got a situation where you've got, but they're in the PE funds that have raised a lot of money or at least got a lot of commitments are very much interested in finding some big deals to put money behind, aren't they?
They are. And we'll continue to see some throughout the year. It won't be, the high caliber, high quantity that we've seen before. But like you said, ultimately, at the end of the day, these investors, they have money, they have capital commitments that they have to put to work. That's how they get paid. They got to get out there, create value, find those investments, put their limited partners' money to work. So they're going to do things like finance with more equity, right? Lower leverage, or maybe the deals that do close, we'll see them structured a little bit differently, maybe a little bit more. They'll start to expect sellers to roll over a little bit more equity. We've also seen that in the deal environment, right? Buyers know multiples are coming down. Sellers don't. Sellers still have memories of their friends and colleagues and peers selling their companies at elevated multiples. They want the same thing, but with interest rates the way that they are, lending covenants the way that they are, we're just having to see those sort of deal considerations change shape into more contingent payments, more earnouts, or other kind of alternative structuring of those deals. But ultimately, the fundamental fact is, as you point out, is we have a lot of dry powder or money that needs to be put to work, and investors are going to do that. Because that's their job, right?
No, it sure seems like it. It sure seems like the environment is like, with all this credit crunch, with all the crises, with all the interest rates going up, everything else, you could sort of feel the mood shifting just a little bit towards private equity funds, particularly those that have got big capital commitments, big LP commitments, really starting to be anxious and excited again to put that money to work.
Right. Yep. Yeah, absolutely. The thing that, and we've seen this in other cycles though, too, I think, and I think every cycle, investors get a little bit smarter about it, but I'd be remiss if I didn't mention is we go through these cycles, and I think then we have some sponsors, some investors who say, okay, we got to put this money to work. You know what? We haven't invested in healthcare before. Let's get serious about healthcare. Let's find some healthcare deals. It's a highly fragmented industry. We've never been in, or replace healthcare with any number of industries that maybe that sponsor just hasn't worked in the past. I mentioned healthcare because it's my primary focus, and we certainly see it in healthcare. But I know we see it in other industries, and I would just advise caution. Just as you're searching for deals and you're trying to put that money to work. It's a strategic decision to go into another investment or into another industry or go into another asset class, right? They're got to be serious about and committed to. Otherwise, I think in general you have more success really just sticking to what's been successful in the past and maybe just reevaluating how you find deals in those asset classes or in those ecosystems that you're familiar with.
I mean, this is so true. I think people sometimes assume that they're smart in one area, that they'll be great in another area. And what you find is the closer that one sticks to their core area or adjacent to their area, the more likely they are to be successful. And so if you're going to dig into other areas, you could do it. You just have to be quite committed to really making the effort to really dig in and learn that area, because it's hard to replace the years of experience you had in a different area, is my perspective. But I think you're exactly right on in the caution in shifting areas and so forth. Matt, anything else you want to share with us today on the Becker Private Equity Business Podcast?
Yeah, I would just say, in terms of the interest rate environment, that's something we look at all the time too. We've also been doing a lot of research, and it's on our website. People can find it if they're interested. Just on what does the consumer look like? What does consumer spending look like? And we think we're of the mindset that we have this huge shock to consumer spending and household balance sheets with the pandemic, and not only spending patterns but also just cash on the balance sheet. And as we recover from that shock, some households have been able to retain a lot of cash, others have not. Housing prices have changed dramatically. Some households are locked into very low interest rates on their mortgages, others are not. And over the next 5, 10, 20 years, we think this is going to create dislocation amongst those different consumer classes. And I think as we go through and build businesses, buy businesses, revise investment theses, try to improve our businesses, we have to stop thinking about the consumer as this sort of homogenous group of people that want to spend every dollar that they get, right? That's just not the case. And different groups will have different spending proclivities, different spending amounts, different spending power, and we really have to dig down deeply into that whenever we're evaluating businesses or as we run them and try to create that value, because it gets so much talk about it being this homogenous group of the consumer, but that really doesn't exist. They're all so different.
No, and the reality is it's very different based on what store, which type of what they patronize and so forth. You see this issue recently, and this. In general, consumers have spent down a ton of their pandemic savings. They've also loaded up on debt, on credit card debt, $1 trillion plus, which costs some crazy number, $200 billion a year to service, plus home equity loans. And so at some point, this is the tipsy-topsy concern here, is that if you do have a recession, people lose their jobs, there is a huge percentage of consumers that are more fragile than we'd like them to be. At the same time, you've got some percentage of the households that are pretty flush regardless, and so you really do have to differentiate between groups of consumers, people, individuals, and stuff like that. That's where probably some of this AI really gets helpful in terms of really or predictive analytics as to who's got money left and who doesn't, because it's really a real mix.
Well, yeah, and underlying all of that, the conversations that we have to kind of remind you, talk about the mix and how it's important to think about them differently. And if we think through kind of the past two recessions, the COVID pandemic, which wasn't maybe technically a recession, but still walk, talk, act like a recession was a recession, and the global financial crisis. These things kind of affected all consumers, all businesses at once, right? I mean, different people had different impacts, but it was something that happened all at once. And as we talk about the state of the consumer, the state of businesses going forward, and we hear all these calls from economists and now from staff analysts at the Fed about a recession in the second half of 23, which is consistent with RSM's own call, for what it's worth. It's not going to be like that, most likely, right? It's not going to be this kind of snap event that affects all people and all businesses, all consumers at the same time and then is over. It's going to be rolling through different ecosystems, different consumer classes, different geographies at different times. And it's going to require some deeper strategic planning, some deeper analysis to really get our arms around what does this mean and how do we navigate it.
No, I think that's exactly right. And it's really an important point. So we do think of this as it's almost like people talk about the pandemic. We're all affected by the pandemic, but many of us are affected differently. And it's very similar when you talk about wealth in America and how things break out and how the consumer acts and operates. We are all affected a little bit differently by different things. And I think that's right. We did talk this morning about this unfortunate paradox of investing in another podcast, where sometimes those people with less money take more risks in their investments because they feel like they have to catch up. And it's just an example of what you're talking about. Each consumer is very different. It's not just one iconoclast group of consumers. It's a very different group. Like it's a very different group of investors as well. It's a fascinating point. Matt, I want to thank you again for joining us in the Becker Private Equity Business Podcast. Always brilliant. Thank you so much for joining us.
Thank you, Scott.